Over the past 12 months, the stock market has risen by a substantial amount. With this uptrend, we've seen plenty of changes in the market climate that could potentially hurt both new and experienced investors. Most recently, at Berkshire Hathaway's 2021 annual meeting, Warren Buffett and his right-hand man Charlie Munger discussed their thoughts on whether the current stock market is worth investing in at this moment and what red flags they are seeing. In this video, I will cover their thoughts on the future of the stock market and the US economy as a whole. Welcome to Kazgains Academy. If you're new to the channel, please consider subscribing for more content like this, and let's get right into it. Although the stock market has risen by a significant amount lately, Buffett actually thinks that the valuations are justified. This is because the main driver behind the stock market's massive move upwards created an environment where such valuations are warranted. And by that, I'm talking about the fiscal policy from Congress and the monetary policy from the Federal Reserve. The Fed's policy for zero interest rates in particular has made it so that bonds are not attractive at all. A common metric that is often used to compare stocks with bonds is the earnings yield versus the 10-year Treasury bond yield. The earnings yield is the percentage of earnings that stocks return for investors, and the bond yield is the annual return that bonds return. By comparing these two statistics, investors can see whether bonds are more attractive than stocks and vice versa. As you can see in this graph, the bond yield is significantly lower than the current S&P 500 forward earnings yield. From 1980 to the early 2000s, the bond yield was comparable to the earnings yield. Stocks are incredibly undervalued even at the current valuations, and these numbers show this. If you invest in treasury bonds, your returns will be practically zero given how low interest rates are. On the other hand, if you invest in companies, you'll get earnings, which is certainly a lot better than getting basically nothing from treasury bonds. We all have to invest our money somewhere, whether it be in the US dollar, stocks, real estate, bonds, commodities, or crypto. When you compare stocks with the other asset classes like bonds, then stocks are clearly a no-brainer. In Berkshire's meeting, Buffett talked about how there's a direct relationship between interest rates and asset prices. The relationship is so strong that it is similar to how gravity relates to matter. Gravity is the universal force of attraction for matter, and he uses this as a hyperbole for how strong the relationship between interest rates and assets is. If interest rates are this low, then asset prices must go up. Buffett then proceeded to show how there was a 4-week treasury bill sold by the government's treasury department at 0% interest. This is clearly unprecedented and practically justifies the current asset prices.
What's your mindset when you see so many of these high flyers, not the GME or meme stocks, but more like the big tech growth stocks gaining 50%, 100%, 200%, etc. in a matter of a year or less? I know you eventually bought Apple in 2016 because of the quality of their businesses and their management. How do you assess if these high flyers are worthy of your investment given this crazy high valuations that muddy the waters?
Well, we don't think they're crazy. But we don't, at least Charlie, I feel that I understand Apple and its future with consumers around the world better than I understand some of the others. But I don't regard prices, and that gets back, it gets back to something fundamental in investments. I mean, interest rates, basically are to the value of assets what gravity is to matter, essentially. And on the way out here, I tore out a little clipping from the Wall Street Journal yesterday. Probably the only one that read it. It's so small, I'm having trouble finding it. It says average price 100.0000000, 6 zeros. And essentially, people were giving $40-some billion to the Treasury, and they offered to give $130 billion or something, whatever the amount tendered. And the Treasury received the money at zero. And Janet Yellen has talked a couple of times about the reduced carrying cost of the debt. If I could reduce gravity's pull by about 80%, I mean, I'd be in the Tokyo Olympics jumping. And essentially, if interest rates were 10%, valuations are much. So you've had this incredible change in the valuation of everything that produces money, because the risk-free rate produces really short enough right now, nothing.
Now, while free money sounds fantastic, the party must end and there has to be consequences. The Fed's 0% interest rates and quantitative easing may have been necessary, but there will definitely be some consequences, whether it be a small or large degree.
It's a fascinating time. We've never really seen what shoveling money in on the basis that we're doing it on a fiscal basis while following a monetary policy of something close to zero interest rates, and it is enormously pleasant. But in economics, there's one thing always to remember: you can never do one thing. You always have to say, and then what? And we're sending out huge sums. I mean, the President said it on Wednesday: 85% of the people we're going to get a $1,400 check. Or 85%. And a couple of years ago, we were saying 40% of the people never could come up with $400 of cash. So we've got 85% of the people getting those sums, and so far we've had no unpleasant consequences from it. I mean, people feel better. The people who get the money feel better, and people who are lending money don't feel very good. But it causes stocks to go up. It causes business to flourish. It causes an electorate to be happy, and we'll see if it causes anything else. And if it doesn't cause anything else, you can count on it continuing in a very big way. But there are consequences to everything in economics.
Now, while zero interest rates are certainly a major movement in the economy and have huge implications, there's something that could be as profound occurring, which is the rise of the Reddit subreddit Wall Street Bets, also known as the Robinhood investors. Warren Buffett thinks that Robinhood and other platforms are taking advantage of people by allowing gamblers to bet on short-term options. In particular, Robinhood is accentuating the prominence of the casino aspect of the stock market, which is very dangerous going forward. Charlie Munger also called this movement from Wall Street Bets as a quote-unquote waving a red flag for the bulls, which definitely hints at his opinion about an upcoming stock market correction, whether it happens in the next few days or the next few years. He then proceeded to call Robinhood's actions deeply wrong and awful.
It's become a very significant part of the casino aspect, of the casino group, to those gambling chips. When people have money in their pocket for the first time, and you tell them they can make 30 or 40 or 50 trades a day, and you're not charging them any commission, but you're selling their order flow or whatever. I hope we don't have more of it, I'll put it that way. And I will be interested in reading the prospectus. Charlie?
That is really waving the red flag of the bull. I think it's just god-awful that something like that would draw investment from civilized men and decent citizens. It's deeply wrong. We don't want to make our money selling things that are bad for people.
But we got the states doing it with the lottery,
No, but that's bad too.
Yeah, and I understand.
That's very
but I mean,
bad.
Once you
very bad.
First,
That's
yeah.
one of the things that's wrong with it. It's getting respectable to do these things. The states are just as bad as Robinhood.
Well, in a sense, they're worse. I mean, they're really taxing.
I know
people based on
I know.
Yeah, they're taxing hope.
Not only that,
And they don't get much in the way of taxes from here, Charlie, when they do that.
The
We don't
states in America.
Charlie Munger clearly believes that the rise of these types of investments is a warning sign for the entire stock market. As some of you may already know, Warren Buffett and Charlie Munger are both heavily against Bitcoin and the rise of cryptocurrencies in general. When asked about cryptocurrencies, Buffett was scared of answering the question and admitted that he was going to dodge it. On the other hand, Munger was not, and essentially spoke up about Berkshire's overall opinion on crypto. Munger reiterated his stance that the rise of Bitcoin is another red flag for the stock market, and of course he hates Bitcoin.
Now that the crypto market overall is valued at $2 trillion, do you still consider cryptos as worthless artificial gold?
Well, I knew there'd be a question on Bitcoin or crypto. And I thought to myself, well, I've watched these politicians dodge questions all the time, and I always find it kind of disgusting when they do it. But the truth is, I'm going to dodge that question because we probably got hundreds of thousands of people watching this that own Bitcoin, and we've probably got 2 people that are short. So we got a choice of making 400,000 people mad at us and unhappy, or making 2 people happy, and that's just a dumb equation. So
Those who know me well are just waving the red flag of the bull. Of course, I hate the Bitcoin success, and I don't welcome a currency that's so useful to kidnappers and extortionists and so forth, nor do I like just shuffling out a few extra billions and billions and billions of dollars to somebody who just invented a new financial product out of thin air. So I think I should say modestly that I think the whole damn development is disgusting and contrary to the interests of civilization. And I'll leave the criticism to others.
Given the controversy, I'm sure many of you disagree with Munger on this subject and some of you may agree. Either way, one thing is for sure, the financial market is changing drastically, whether it be for good or for bad. The new generation is implementing digital technologies in the financial sector, and it's not a surprise that those from the older generations like Buffett and Munger are not a fan of it. On one side, you can argue that the old always look down on the young, and Buffett and Munger's advice shouldn't matter since they aren't competent in this new digital wave. On the other side, some may say given Buffett and Munger's experience, we should be listening to them since they've been through so many technological transformations and market climates. Let me know which side you believe in the comment section below. If you enjoyed this video, please hit the like button and don't forget to subscribe, and I'll see you in the next one.